Welcome back to the channel, guys. I just wanted to cover off Feppy from Rec Shares. It's just been released for European investors. I just want to kind of cover how similar it is to its US parent, a little bit around what's in the fund, and we just do a bit of analysis as always. So it's the Rec Spang and Innovation Equity Premium Income ETF, which runs a cover call strategy, and we're going to talk about its performance, its risks, its recent European expansion. The parent fund has 477 million assets under management. So this isn't a replication of the US version directly. So it's not like we're owning that version of the underlying, but it just gives you an idea of how that one is performing to start with, because that's the only thing we have to go off right now. It has a distribution rate of 25.2% as of recording today. The 30-day SEC yield is negative 0.22, and we'll talk about why that's important. And we have an expense ratio of 0.65, beg your pardon. It's not the most expensive, but it isn't the cheapest out there either. So the Feppy strategy, so how does it work? So Feppy aims to generate the monthly income by selling covered call options on a portfolio of technology stocks. The process is to basically turn market volatility into potential income streams. And so I've done a lot of videos on volatility in cover calls. Just go back and watch some of those videos to give a bit of background on that side of thing. My assumption is that you're probably watching this because you already know that part. The actual FEPI strategy, it holds a portfolio of about 15 to 20 leading US technology stocks, sells call options on these stocks, collects an upfront cash payment premium, distributes the income generated from these premiums to investors monthly. So the typical trade-off that we see with all cover calls is the strategy generates income, but obviously caps the potential for capital gains. So if the stock price rises significantly above the strike price, the fund misses out on those extra gains. So if it's riding strike price on those underlying 15 to 20 stocks, and any one of those rallies, then it can go through that strike price, capped out that strike price. All right, so a deep dive into the US FEPI fund. It's mostly concentrated in, the tech sector. 67% of that is weighted there. There is some in the consumer cyclical, around 13%, and then almost around 20% in the rest in comms. So, just kind of gives you that breakdown. In terms of the top equity holdings, AMD, Broadcom, Nvidia, Netflix, and Intel. In terms of performance, obviously this chart illustrates the kind of capped upside of a cover call strategy. So since inception, October 2023 to March 2025, Feppy's NAV return was about 10.74%. So not bad, 10%, but obviously it does lag the S&P, which is 28.76 over the same period. So 10% foregoing on the upside. But still the returns are not bad. Okay. In terms of the income story and the monthly distributions, Feppy has consistently paid monthly distributions, though the amount quite varies as you'd expect. The median monthly payments are around about $1, just over that. And we can see kind of the payments are kind of a bit all over the place. What's obviously worrying is the payments have taken quite a drop in the last sort of 6 months. Some of that might be due to the market volatility not being the best. And the situation with the tariffs and the tiff that's happened with Trump and Musk may have impacted some of this. But it's crucial to understand that the difference between the distribution rate and the negative SEC yield. So the backward looking measure, the distribution rate is 25%, as we said. Obviously, this reflects past payments, related to the share price, which can be slightly misleading. The 30-day SEC yield is kind of more forward-looking, indicating that the fund's kind of expenses are exceeding the investment income, suggesting distributions are largely a return of capital, which could erode your principal investment. Kind of like just understanding return of capital, and I have kind of touched on this other videos, it's kind of a bit of a double-edged sword. So return of capital means you're getting back a portion of your original investment, not just earnings. It has both potential benefits and drawbacks. The potential pros of ROC is tax deferrable. So return of capital distributions are generally not immediately taxable as income. They can be kind of deferred tax liability until you sell, potentially at a lower capital gains rate. Specific fund structures, common and often expected to certain investments like REITs or LMPs due to like non-cash deductions, kind of depreciation effect. And then the constructive ROC can occur when a fund has unrealized gains but chooses to distribute capital instead of selling asset, potentially optimizing tax efficiency. The only thing I would say about tax deferral, it obviously depends on the region and the country you live in. So as always get tax advice. In terms of significant cons, principal erosion. So obviously if distributions are exceeding earnings, then you are genuinely getting your own money back, and which directly reduces your initial investment and the funds now. Yields can sometimes be a little bit misleading. High distribution rates can deceptively, if largely composed of return of capital, masking sort of poor underlying performance. It can also reduce future earning power. So think about, as a principal return, the fund has less capital to invest, potentially hindering future income and growth. And we can see that with some cover call strategies that we've seen that in the past. The higher capital gains on sale. So while taxes are deferred, the reduced cost basis ultimately means a larger capital gain and thus a higher tax when you eventually sell your shares. So it's just something to bear in mind. So for FEPI, the negative 30-day yield strongly suggests that obviously the FEPI distributions considered disruptive or destructive return of capital, which can erode your principal investment over time, despite obviously that high 24% rate. So how does this translate to total return? Because we always talk about in the channel, total return is all you need to worry about. So how can we saw earlier that it's got a positive 10% return. So how can it have a total return that's positive, but a negative SEC yield and return of capital? So surely the NAV's going up. Well, so just to kind of dig into this a little bit more. So total return is the overall gain or loss on your investment. So it combines the capital appreciation, change in the share price, and the distribution. So even with a negative SEC yield and a return of capital, total return can still be positive if capital appreciation is strong enough. Okay. So capital appreciation, increasing the fund's underlying assets, which part of that is of the shares that it owns. The distributions, obviously the cash payments received, the income, plus the ROC can still give you an overall gain or loss on your investment. Okay. So for FEPI, despite its negative SEC yield and distributions, including ROC, the significant capital appreciation on its underlying tech holdings, even with the cap gains from the cover call strategy, has led to a positive total return since inception. So this kind of highlights, while ROC can erode principal, strong market performance in the underlying asset can result in overall gain. In terms of a risk reward profile, sort of key considerations obviously is that NAV erosion element to these high yield, high income strategies, where high distributions that are return of capital can deplete your initial investment over time. You've got the usual cover call issue of a capped upside. You'll miss out on the largest gains in the underlying tech stocks during that strong bull run or bull markets. Another thing to kind of bear in mind with FEPI is it obviously has a sector concentration, and we saw that with that pie chart where it's heavily focused on volatile tech sector, which means it could swing around quite a bit. Derivatives risk, obviously option strategies are complex and carry risk beyond just simply owning a stock. Obviously, there is a flip side to this, and that is the potential rewards. So you've obviously got the high current income. The primary objective is obviously to provide that significant regular monthly cash flow. It's obviously got exposure to tech leaders. It It's got investments in the FANG and other innovative companies, which are ultimately shaping the world and the economy. So, that is a good thing. Obviously, there is a potential downside buffer. So, if there was a market correction, the premium can partially offset that. In small sideways movements or small declining movements in the market can actually be a good hedge, and you could even outperform in the particular user cases. Income diversification, obviously providing a source of income that's, not reliant on typical dividends. So a typical dividend investment would be a stock that is generating income from revenues, and then it's sharing some of that revenue with its shareholders in the form of dividends. So obviously it's a slightly different strategy when you're doing it on options. So Feppy has gone global as of today, recording this 2nd of July, 2025. Just to kind of give you a bit of a comparison between the US shares and the European version. Obviously, from a regulation standpoint, the US is kind of the framework is the SEC framework. In Europe, it's the UCITS focused version. In terms of number of holdings, it's 15 equally weighted stocks in the case of the US version. It's the 20 leading US stocks in the European version. In terms of a call strategy, from what I could find out there, it was a 5 to 10% the money calls. Whereas on the Rex shares European version, they've kind of called it out as up to 10% out the money. Now, in terms of the call frequency, they are both monthly call strategies. So it means that they do make sure they kind of iron out the volatility from week to week or day to day. So it's not like some of these other single tickers that are weekly where, the volatility is quite aggressive. From an expense ratio, it's the same, 0.65. And then obviously you've got, in terms of the income, you've obviously got that, but then you've got capped upside to think about. Just another point of note, the European version is powered by an ETF. So they are a white labeler for some of these new US kind of funds that are coming out from the States. Hani ETF are kind of wrapping them up on behalf of Rex shares. They're also doing it for Yield Max as well. So shout out to them as well. Okay. So who is Feppy for? It's, designed for income seeking investors who want exposure to the tech sector and are willing to sacrifice basically that capital appreciation for basically high potential monthly cash flow. Obviously, investors must be comfortable with the risk, the NAV erosion, the volatility of the tech market. Obviously, it's very important to understand those and appreciate those levels of risk. Obviously, this will be quite interesting when we look at the fact that the YMAG has come out from Yield Max, again, interestingly powered by an ETF. So I'm interested to see how these two perform. The fees are slightly higher there. The number of stocks that are covered are slightly more, handful more. So again, interesting to see what the overall long-term performances of these newer funds that are coming out to Europe will be like long-term. So there you go, guys. Hopefully that was useful. A lot of people have been asking me to do some sort of comparison and overlay of FEPI and the European version versus the US version. So hopefully that kind of helps. I'll catch you on the next one.